the conference call to discuss the performance of third quarter of fiscal year 2018. We have with us Mr. Godrej, Executive Chairperson, Vivek Gambhir, Managing Director and CEO, V. Srinivasan, CFO and Company Secretary, and Samir Shah, Head Finance, India and SAR and Investor Relations. Like our previous quarters, we will start with a presentation with Vivek sharing his thoughts on our performance, and then we can open up for Q&A. Over to you, Vivek.
Thank you very much, Tapan. Thank you, Harit. It was a reasonably good quarter where we delivered competitive and profitable growth while continuing to make healthy investments in our brands. The performance was led by India, which delivered an 18% volume growth. The number though needs to be viewed in the context of the low base in the corresponding quarter last year. However, even on a two-year basis, the volume growth was quite healthy at 8%. Along with the strong volume growth in India, EBITDA grew at a very healthy 32%, driven by a better portfolio mix, some benefit of lower commodity costs, and the benefits from our cost reduction programs. This profit growth was delivered while investing in our brands. Our marketing investments increased by 24% year-on-year. We believe that these investments are strengthening our brands and are also setting us up well to accelerate growth in the quarters ahead. Our team has been very agile in navigating the continuing transition to GST. We took price cuts of about 6 to 10% across the relevant categories to pass on the benefit of the rate cuts that were announced in November to consumers. Overall, the environment is getting more stable now. The trade channels are largely back to normal. Consumer demand is improving, and we expect stronger demand in 2018-19. We are intensifying our pace of new launches to build on the momentum that we are seeing. The recovery in rural has been stronger than urban. While urban did well, rural pickup was much better. Given the likely focus of the government on rural development, rural infrastructure, and rural growth, we believe the rural demand will be one of the key themes in 2018-19. Turning to our international business, our international performance was below our expectations, largely due to some one-offs and some transient hiccups. In Indonesia, our business continues to show a gradual sales recovery in the midst of a continuing tough environment. We have, however, managed to deliver good profit growth in spite of the sales challenge. The outlook for Indonesia is more positive this year, and so we are hopeful of the recovery gaining more steam. In our Africa business, our hair extensions business continued to grow in double digits. The scale-up of our wet portfolio is seeing good traction. However, we saw growth in Kenya slow down in the quarter due to the political and social turmoil in the country because of two back-to-back presidential elections. The outlook for Kenya is better this year. Our US business also got impacted due to an implementation of a new ERP system. The system has now largely stabilized. We are very confident of Africa and the US delivering stronger growth in the quarters ahead. And we're continuing to make a lot of investments in people, brand building, and factory infrastructure to strengthen the foundations of the business. Overall, we are very excited about the medium-term potential of our international portfolio. While there will inevitably be occasional hiccups, we remain very committed to making the right investments and ensuring that the portfolio delivers strong returns. I'm also very pleased to inform you that our board of directors today approved the nomination of Pippa Armerding as director effective immediately. Pippa is based in Johannesburg, and she is a lawyer and a business professional with 20 years of experience operating across Africa, Asia, Europe and the Americas. The Africa continent is extremely important to us from a growth perspective, and PIPA's deep knowledge and expertise of the continent will be a strategic advantage. We are also proud that GCPL will now have 5 women directors, the most in any Indian listed company, along with Godrej Agrovet. I'll just quickly walk you through the presentation and cover with you some of the highlights, and then we can open up to questions. On slide 3, we summarize our financial performance. On a consolidated basis, net sales grew at 11% on a constant currency comparable basis. EBITDA growth was 18% on a constant currency basis, and net profit was a 21% growth without exceptionals and one-off items. Slide 4 lays out the exceptional items in the quarter. Slide 5 shows the bridge between reported to operating EBITDA, like we do every year. Next slide, we talk about the balance sheet data. Again, if you look at the balance sheet metrics, they're all trending in the right direction. So we continue to make very good progress in making our balance sheet much more robust. If you take a quick look at our India performance on slide 8, as we had mentioned earlier, we saw 17% growth, comparable growth. It was driven by a very healthy volume growth of 18%. The EBITDA growth was at 32%, along with continuing to make very healthy brand investments. And slide 9 lays out our volume growth, and the sales growth was led entirely by volume growth. On slide 10, and I'll spend a little bit of time, on this particular slide. Generally, while our performance has been very healthy, we did see some softness in our insecticide business. This was driven by a bunch of different factors. Some of the factors were more seasonal in nature. The delayed onset of winter actually impacted this business a little bit, particularly in the north and the west, and so that saw an impact. And we saw lower incidence of mosquito-borne diseases this quarter as well. And we did not see the kind of growth bouncing back in HI as a category like we saw in some of our other categories. And this is also borne out by data from the external research houses and from the performance of the other players. The potential for growth is very significant in this category, as you know. Also, to a certain degree, some of the other categories which saw a lot of growth did benefit from price cuts. This was one category where there wasn't any price cut in the quarter. But clearly, the potential for growth is very significant, and so we have begun significantly dialing up our efforts in innovation. And over the next few quarters, you will see several exciting launches from us that will help us get this category back to the kind of growth trajectory that we would like to see from this category. The other important point to mention is that we have been doing relatively well as far as the value-added formats are concerned. And so in our value-added formats, we continue to gain share, but we have experienced some pressure in the more commodity formats like coils. But our innovation agenda will try and cover the entire portfolio. So you will see new launches from us across all the formats over the next 6 to 12 months that will help us drive significant growth going forward. On hair color, very strong growth driven by volume. Expert Creme did very well, and what was also very encouraging to see was a strong pickup in powder hair colors post the GST-led price cut. Our growth momentum in soaps has been sustained. I think this is the third quarter where we have seen very good growth in soaps. Both Godrej #1 and Synthol have done very well on the back of some very strong marketing initiatives and good execution. This is the season where a liquid detergents portfolio, Easy, does well. It's a seasonal category, and we've seen some strong growth in Easy as well. Across the board, I think our new launches are doing well, but as I mentioned to you, we are intensifying our pace of new launches, and so over the next 6 to 12 months, across all of our categories, you will see a very healthy mix of very differentiated new products. We've been working on these over the last couple of years, and we're very excited to launch these over the quarters ahead. Turning to our international business, as I mentioned to you, the performance was mixed. We are laying the foundational elements for international to perform much better, but the performance in this quarter was below our expectations on both sales and on the profit line. On Indonesia, the performance is recovering, and I think the macro environment in Indonesia is still quite difficult. For the sector as a whole, home and personal care growth is still negative. The outlook for 2018, however, is more positive, and so we are hopeful of the environment improving. The encouraging news is that sequentially, if you look at our performance, our sales decline has narrowed down. The decline was 2% in Q3 versus a 7% decline in Q2 and 11% in Q1. So the trend is heading in the right direction, and while sales growth has been a challenge, we have ensured strong delivery of bottom line. The strategy going forward is to focus far more on innovation. Here again, we have launched a couple of interesting products. There are more launches planned over the next 6 to 12 months to change the narrative from a very discounting-led approach to a more innovation, brand-led approach across the categories. And we're also putting a lot of focus on transforming our go-to-market model to increase focus on general trade, where we have a relatively low channel salience. So we are hopeful of a continued recovery going forward. On slide 21, we talk about our Africa and our US business. In this portfolio, we saw continued double-digit growth in hair extensions. The wet hair business is seeing good traction on the ground, and we are very hopeful of seeing a positive contribution from this business over the next few quarters. The quarter did see a lot of turbulence in Kenya that went through 2 back-to-back presidential elections, which significantly impacted the trade environment. The macro outlook for the country is much more positive for 2018. In the US, we migrated to a new ERP system, and the implementation caused a lot of upheaval as far as servicing US customers was concerned. The system is now getting far more stable. We are making lots of upfront investments in new talent, in brand building, in new factory infrastructure, and that has impacted near-term margins. However, we believe this is the right call to strengthen the foundations of the business. Across the board, there is great work happening on the ground in terms of new talent coming on board, brand building, new product launches, scale up of our wet portfolio, and driving operational efficiencies. We believe that we are very well geared to deliver stronger growth in the quarters ahead and to capitalize on the tremendous potential that we see in the region. The performance in Latin America was soft this quarter, but we are hopeful of seeing the growth return back in Q4. Europe continues to see good momentum on both sales and earnings growth. That's on slide 23. Slide 24 basically is a summary of our third quarter performance. Let me just pause here and then turn it over for Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star, then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then one. We take the first question from the line of Abneesh Roy from Edelweiss. Please go ahead.
Sir, congrats on good performance. My first question is on the soaps business. So if you could talk about Synthol. In the presentation, I don't find any mention of Synthol. How is the performance of Patanjali? Earlier you have said in soaps, Patanjali has had limited impact. Is it now worse or is it better? Could you talk about the micro-marketing initiatives and the variant strategy, which is doing well for Godrej number one? How much was the benefit from upstocking because of the rate cut? So these are the four sub-questions.
Avnish, our secondary sales were higher than our primary sales. And so I think that's a good indicator in terms of how to think about any potential, upstocking. And I think for multiple quarters now, the discipline we've been maintaining is to try and always look at both secondary sales and our primary sales. In fact, our sales teams actually measure themselves on secondary sales, not on primary sales. Synthol has done very well. Godrej number one, we have multiple variants. All of them are doing very well. We've had a very strong focus in terms of targeting specific states and making sure that our portfolio applies to a broad set of consumers in the states. I cannot comment on the impact of any other competitor, but from our perspective, I think we've been pleased. Our shares have been inching up, as you know, and so we are pleased with our performance consistently over multiple quarters now.
Sir, last 4 quarters, in fact, has been good for soaps. That is on a base of softer 4 quarters prior to that. So now going ahead, when base is no more favorable, do you still expect to grow faster than the industry? And will this be largely led by Godrej number one? And who are you gaining share from?
It's difficult to comment on exactly who are we gaining share from. But, it would be, several players in the market. But I think this is a category where clearly, we do believe that our story is quite differentiated. We have the best quality soap and the grade one soap in number one. Synthol also has a very unique proposition, and I think our marketing is working for us. Over time, the growth will stabilize. As you know, this is a very penetrated category. But through, I think, tapping into additional states that we'll focus on, probably expanding the portfolio with more adjacencies, intensifying our focus on things like hand wash and liquid washes, etc. We do see the potential for us to be able to grow faster than the industry. But this is an industry or a category which does, grow at a slower pace. And so we know that the growth will stabilize over the medium term. But certainly from our perspective that we feel confident that given our innovations and our go-to-market execution, we should be able to outperform category growth.
So my second and last question is on the HI. Here if you see how much is the percentage of coils currently and how much is value add. You mentioned value add is doing much better. And so in coils, did you see in Q3 still impact of the wholesale? Why I'm asking this is some of the companies who have a high wholesale component in some of the brands, they have still seen a very tough Q3. So have you seen similar in Q3? And finally, if I see HI over the last many quarters, last 5 quarters, it has been flattish to mid-single growth. You have pointed different reasons. Some could be GST and some could be demand, some could be seasonal. But if I see prior many quarters, we never saw this kind of a lower growth in HI. So obviously there seems to be something more beyond the seasonal or the GST, etc. So if you could address that part.
So Avnish, I think just in terms of data point to begin with, value-added portfolio would be more than 65 close to 70% of our overall household insecticide, and the mass, let's call it that way, would be the rest, which largely would comprise of coils as well as paper-based, mosquito repellents. I think what we're seeing to begin with in this category is, at least in this quarter again to begin with, is a little bit of seasonal impact. The issues in terms of wholesale impacting mass formats is a little better in quarter 3 as compared to what it was in quarter 2. It's still there though. So that also in its own way would have smaller impact, always difficult to quantify. Yes, we have seen actually, last 3-4 quarters consistently or little more than that perhaps, relatively softer, growth. The point is this category sits somewhere in between a staple to a classical discretionary, space. So to that extent, we have seen a little bit of, slower consumption at category level, and we being market leader, are also seeing a relatively, softer growth. Having said that, as Vivek also mentioned, in his opening remarks, we are working towards, multiple initiatives, whether it be stretching the consumption, driving penetration, and we will see a couple of very interesting launch, what we feel from our end over, next quarter to two, which we think should, help us in terms of driving both the stretched, consumption as well as the higher penetration objective, and in turn should result in growth rates, which will be much better than what we have seen over last, 5-6 quarters.
Yeah, I think the big objective for us, and clearly we're not happy with our performance over the last 3 or 4 quarters, as you mentioned. The big objective for us is to grow the category. We've done very well in terms of share gain, and we continue to believe that our portfolio allows and our distribution allow us to incrementally gain share. But the big focus needs to be to grow the category. To grow the category requires strong innovations. Because of the lead times required in launching new products, this can be both an advantage, but it does take time. And so a lot of the groundwork that we've been doing over the last 2 or 3 years, over the next 1 to 2 years, you will see very exciting launches which have been worked on. That should allow us to be able to drive penetration. So the need of the hour is for us to be able to find ways to increase penetration. And I think if we can do that, you will start seeing growth return back to the historical numbers that we have delivered.
That's quite useful, sir. Thanks, all the best.
Thank you, Avnish.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. If you have any further questions, you may come back for a follow-up. We take the next question from the line of Amit Sinha from Macquarie. Please go ahead.
Yeah, thanks for the opportunity, sir. My first question is on the HI business again. Now, as you mentioned that it is, the category itself is a bit of discretionary in nature, and that would have led to some softness in the demand in the last few quarters. So my question is that at the current level of pricing, especially in the liquid format, do you think affordability is a major issue, and are some of the innovations which you talked about will address this?
There are 4 drivers in insecticides: affordability, efficacy, safety, and convenience. And I think as the market leader, we have to address all those consumer needs and have a full format of products that will address the needs. Some products will focus more on efficacy. Some might be on affordability. Some might try and do both. Some will be focused on convenience, and across the board will make sure their products are very safe. So that's the part we need to play. It's just taken us some time to get the portfolio right. But as the market leader, we have to find a way to be able to find ways to upgrade our coil consumers, find ways to create more affordable products. And so what you see from us over the next year and 2 years will be a fairly exciting set of new launches that address all the issues that you've Amit outlined.
Sure, sir. But at the same time, my question is that if you address this affordability issue, liquid, as we all know, is a high margin product. Is there a risk of the new product or any of these innovations which might be affordable might eat away into the margins of the segment?
We don't believe so, and it's not that we don't play in affordable segments in any case. I mean, if you look at fast card or foil, and actually the per night cost of LV is lower than actually the per night cost of coil. It's just because of the machine, electricity, the put down price of the bottle that it gets higher. But like Vivek said, obviously, we're not going to tell you exactly what we're going to launch, but we are sort of very, very confident of covering sort of all growth vectors in this market. And don't forget, even something like personal repellent on our fabric roll-on has been doing really well. That's a 75 rupee price point. We also have a 20 rupee personal repellent product. So we will cover all price points, and penetration is the name of the game for us. But I don't think, I would call us necessarily just a premium player. We play across all price segments, and we'll continue to do so with better and better products.
Sure. So my last question is on basically on the GST gains, which has been happening on both your soap segment and hair color. Now, if I get into the sub segments, then clearly number one and powder has gained significantly, and the growth rates, even if I look at 2 years CAGR basis, it is at this point of time, it is definitely super normal. So how should we look at going forward? Is it a 1 quarter phenomena, or you believe that, the powder and both number one can continue to grow at least for the next 2-3 quarters? And your commentary on the unorganized market share gain from the unorganized segment. Yeah. That's
I think just in terms of facts, it's not just powders, but creme, which has also grown extremely strongly, and it continues to be the case. Over last now 2-3 years. Yes, the powders performance has been better compared to what we have seen in some of the earlier quarters, and also on soaps. It's not just Godrej number one, but Synthol, which is also growing, continuously at very, very strong, growth rate. So the performance in Godrej number one is, tad better than, Synthol's, growth rate. Of course, we need to read these numbers, baseline with, what were the growth in the base, quarters. But even if you look at 2-year CAGR, I think they are, much stronger growth rates. Of course, optically this growth rates will normalize, but at this stage we remain very confident, one, of gaining market share, the point which we have been, driving over last, 3-4 quarters, both in soaps and hair colors. And second, also perhaps maintaining very close to the sort of 2-year CAGR growth rates, which we have been clocking over last, 2-3 quarters, even going ahead.
And again, just to put this in context, our 2-year CAGR in soaps was 9%. And 2-year CAGR in hair colors was 15%. And so I think in that context, the growth rates going forward ought to mirror this from the work that we are doing. To your other question around, the shift from unorganized to organized, frankly, we haven't seen any clear trend there. I think the unorganized channel in some ways in India has been quite resilient. So I think over time, as GST creates a more level playing field, some of the players who are not ethical may find it difficult to do business, but so far we have not seen any significant trend that we can call out. Partly this might be the fact that we are still in the midst of a GST implementation and not every single piece has been put in place. So there is still room for non-compliant players to find a way to do business. Over time, it will get harder. If it gets harder, definitely you will see some shift towards the more organized players. But at this stage, it's very difficult to extrapolate and draw a trend from what you've seen in the market.
Thanks a lot, sir. Very helpful.
Thank you.
We take the next question from the line of Vivek Maheshwari from CLSA. Please go ahead.
Hi, good evening, everyone. My first question is on Indonesia. So last quarter, if I recall correctly, you had a 1% decline adjusting for promotion spends and 7% on a reported basis. Is the trend broadly similar? And if so, does that mean that, adjusting or netting of promotion spends, you are actually in positive in this quarter?
So the trend has more or less been similar, Vivek. I mean, there is not much to choose between, percentage in either of the direction. And to kind of also answer your question, the quantum of sales promotion has gone down as a percentage of gross sales in this quarter compared to the previous quarter.
Yeah, but given that the number is this time the decline is so small that if there is promotion which is a smaller one compared to second quarter, you may end up being flat. So is that a fair understanding?
Yeah, that's right. I mean.
Okay. And can you just, I mean, while Vivek did, in the opening remarks, he did mention about Indonesia, but can you just, given that it was such a big pressure point for last few quarters, can you just elaborate on how the competitive landscape is specifically, please?
Generally in insecticides, the level of promotional intensity still continues to be high. While it might be a tad bit lower than what we saw, say, a quarter or two ago, the intensity seems to be, quite high on the insecticides front of it, not in the other part of the portfolio, which is the remaining 2/3 of the portfolio. And what we are trying to do is basically be far more. We are also being competitive in our promotions, but we're being far more surgical and far more analytic in terms of a capability, in terms of where to best direct a promotion, and having a much higher threshold in terms of measuring ROI of the kind of promotions we are launching, in parallel with a much more stronger focus on brand building and innovations. But the intensity still does remain in insecticide space, Vivek.
Okay, sure. And second one, a few years back, you had, or you have been mentioning it over the years, that, your aspiration is to grow your bottom line ahead of top line. Where we are in the commodity cycle right now, the crude being around, or Brent being around $70, do you think that may play out, or you would expect, perhaps bottom line growing either in line or a shade lower than the top line? How do you see the next, let's say, couple of years?
See, clearly our single most important objective is driving volume growth, strengthening our brands, and also ensuring that, we are continuing to have a broad portfolio of new launches. You start with that premise. I think our belief is that at an overall level, and this is at a consolidated level, there is still opportunity for us to be able to drive profit growth ahead of sales growth. Now, you may have a year or so where we start making some investments, and that's a conscious call we'll take. But if I look at our, profit profile, the kind of cost reduction programs that we have, both in India and I think in Africa, we do see opportunities to be able to drive profit growth ahead of sales growth. Indonesia will have to wait and watch, given the competitive environment, and profit margins in any case are quite high. And I think also in Latin America, margins have been somewhat volatile, but there again, there is opportunity to be able to better drive stronger profit growth through driving greater synergies between Argentina and Chile. With regards to the near term, I think you've mentioned, the two most important input costs that can affect, some of these our costs. One is palm oil. Well, it's very difficult to have a long-term view on palm. At least near term, the feeling is that palm oil prices should remain somewhat stable. With regards to crude, that's an indirect variable. And so, any impact of crude typically will not be seen for 1 or 2 quarters. Now, in 1 or 2 quarters, what happens to crude oil prices, depending on what US shale manufacturers, end up doing, etc., is very difficult to be able to really, predict. But at this stage, we are still quite comfortable that, barring any significant new launches that we decide to do for competitive reasons, our abilities to drive profit growth in line, if not ahead of sales growth, still is something that we stand by.
Got it. Just a small follow-up. Have you taken up any product price changes other than the GST cuts? So particularly in the context of, let's say, where palm and crude is to get us, some visibility from a near-term perspective?
No,
Correct, not yet.
and we do not intend to, in the near term, also change any prices.
I see. Okay. Thank you and all the best.
Thank you.
We take the next question from the line of Prakash Kapadia from Anived Portfolio Managers. Please go ahead.
Yeah, thanks for the opportunity. Congrats on a good set of numbers. On the India business, wanted to get some more flavor about the quality of growth. You mentioned about market share gains. You mentioned about low base. So what has worked? Is it, lesser wholesale channel dependence? Is it, price sensitive kind of products which we operate, which have grown faster in our portfolio as compared to premium products? If you could give us some more sense of growth and, how sustainable the growth looks on, because in the opening remark you did mention about, rural growth, going forward looks strong. So, what kind of products are we focusing on in near term, specifically for rural India?
See, at the end of the day, there is no silver bullet answer that I can offer to you. It typically tends to be a function of four different things. One is very good product. At the end of the day, if you create good products, I think consumers will buy, and I think we have some of the best and the highest quality products in the market, and we've continued to focus on our product story. The second is the products are backed by number two, very compelling marketing, and the marketing activations on the ground, sampling, activation programs all seem to be, have worked well for us, at least over this quarter. The third is distribution, which is getting far more analytic, and both direct distribution, how we engage our distribution partners, how we engage our wholesaler partners, how we work with them, how our sales force executes on the ground, is the third piece of, what drives quality of growth. And finally, the secret sauce does tend to be the agility and the passion of any team. And there again, I think, our team has been extremely agile and entrepreneurial. So honestly, there's no one single answer I can give you. When all of these four things work together, you see good quality of growth. And our intent is to keep on learning and driving these four levers to be able to sustain this growth going forward.
Understood. How much would be wholesale for us for the India part of the business, if you can give us some idea?
So around half and half. I mean, half of our general trade would be, wholesale driven.
Wholesale. Okay. Thanks, Samir. And one more thing on, Air, Godrej Air has done well for us. If you could give us some sense on size, reach, in terms of, outlets, levers of growth from here on, because we've done wonderfully well there also.
Yeah, unfortunately we can't share those category information. We believe that we are number one in the category across car and home now, and the brand continues to sort of grow very, very fast. So, we're both very excited about the potential about the air freshener category, and the growth potential and getting in new products. And we are the market leaders in Indonesia in air fresheners also.
Right.
You will see a lot of good things from us at all sorts of price points and different uses. I think the exciting about the very nascent category, because penetration is only 6 or 7%.
Yeah. So I think that's why there's plenty of growth,
right,
for any company that brings in very innovative products to market, because the penetration rate, as Nisa said,
right,
plenty of headroom for growth.
And on the rural pie a bit, we see growth coming across strata of products for us, say in the next 12 months, given the spate of elections and government focus spendings, or some specific products you think will grow faster, some could average out. So which are one or two key products which we think which will grow much faster than others?
See, the good thing for us is across our portfolio, obviously air fresheners will not grow as quickly in rural, though we are seeing some growth there. But soaps, hair colors, insecticides, these are all products. Some of them are staples, some of them are a little bit more discretionary. But across the board, I think once you see a pick up a rural demand, it should start providing a meaningful uptake to most of the portfolio, apart from air fresheners and perhaps liquid detergents. But there again, we do sell a fair amount in sachets. So there is opportunity also on the detergent side of the business.
Pie of the business. Understood. Thank you. All the best.
Thank you.
Thank you. We take the next question from the line of Manoj Menon from Deutsche Bank. Please go ahead.
Hi team, congratulations on a best-in-class performance on India. The first question is actually on the international business. The first sub-question that is on the Africa piece. If you will just take us through, the milestones broadly what you had on the wet hair portfolio, and where are we in that journey? I'm asking this for a couple of reasons. One, that you are investing, which you can see in the margins. Secondly, that the template for wet hair, which is organic, is slightly different from possibly what dry hair, which was, a relatively stabler business which you could ramp up. So the first question is on that. Second is on LATAM. Given the generally high inflationary environment which those countries having, is this constant currency growth? Are you happy with that? Third, on Indonesia, I know that it is being discussed in detail, but when I see the trajectory, while the trajectory has improved significantly, if you remove the fact that, let's say the significant competitive activity levels, etc., has come off, I'm not sure that we have actually improved the trajectory. Is that the right way to interpret Indonesia?
So let me start with Africa. On Africa, the potential for wet hair, as we've discussed before, Manoj, is huge. And a lot of our work over the last couple of quarters has been to localize manufacturing. That probably has taken us a little bit longer time to stabilize, but a lot of the manufacturing is local, and we have spent time in trying to craft the right propositions for the consumers across all the major markets. The products have gone into market. Initial feedback is positive, but I think the real test will be over the next 12 months or so. The teams are very excited, but the scale up now will start accelerating quite a bit. You will see some impact, improvements in Q4, but next year should be the year where we will see a meaningful contribution from the wet hair portfolio across sub-Saharan Africa. So we remain very excited, but the focus really has been a lot more to try and get the manufacturing scale up done the right manner across various countries in Africa, and that's now largely over.
I think LATAM, to begin with, Manoj, as also Vivek shared earlier, we think it's more of one-off. There were some kind of on ground issues more so in terms of macro in Argentina, which led to the kind of growth which is much below compared to even our internal expectations. But I think the teams and also we remain extremely optimistic that come Q4 again we should see extremely strong overall financial performance, primarily driven by sales growth. So I think net on a full year basis, LATAM should be fine in terms of overall business performance, and not just financially but also gaining market share across key categories. So I think this is more of just a one quarter kind of phenomena. By end of the year, I think it should be kind of doing quite well on multiple kind of metrics. Manoj, we just lost you a little bit in terms of your Indonesia question. So if you can just kind of repeat that for us, please.
No, the question was, while I do see the trajectory improvement part, which you have mentioned in the presentation also, and as Vivek Maheshwari asked a little earlier, I understand that part, but considering the fact that there was some bit of irrational competition earlier, which is probably not there anymore, so is that the real underlying trend largely been stable rather than actually? So is it stable, or should I still believe that it's actually improving?
So I think maybe just to kind of circle back on this, what Vivek did mention to one of the previous, kind of, rewards is that, competitive intensity is more or less much of the same. I mean, it has marginally diluted down, Manoj, but it hasn't changed, dramatically. What we have done differentially is, from where we were in first quarter in terms of our quantum of spends, nature of spends on trade promotions, we have kind of made it much more crisper, more specific to few SKUs in few, specific channels. That quantum has reduced down and continues to reduce down for us, starting with first quarter and then second quarter, now, third quarter. To add to that, we have also launched couple of interesting, innovation early days, but those are also kind of contributing to this, gradual recovery. Finally, we think this is, going to be gradual. I mean, it's not going to be a V-shaped, kind of recovery. But as we maintain our stand, since last, 2-3 quarters, that we will continue to see, gradual recovery in Indonesia's, sales. And then I think rest, most of the profits will be a fallout of, how the sales, performance is going to shape up. But yes, we remain very confident that there will be, continuation of gradual recovery in Indonesia with every passing quarter.
Understood. And just quickly on the Africa, of the constant currency revenue, what proportion would be broadly ballpark volumes?
Manoj, I'm sorry again, we are not able to hear you very clearly.
Volume.
So I think in Africa business, I think close to around 3/4 of our growth is kind of price led, and the rest is kind of volumes led.
So that's about 5-6 is volumes and mix, and 4 would be price.
Yeah, that's right. Yeah, that's right.
Okay. And lastly, on the gross margins at a company level, and also standalone, despite actually an adverse mix, which is HI growing at 5, and I know that hair color also has grown, but soaps growing so well. How do I interpret the gross margin? What would be the top 2 or 3 reasons for the gross margin expansion?
So Manoj, I think just to get the numbers right, I mean, if we look at comparable, sales growth and basis comparable sales growth, if you look at gross margin expansion, that comes to, say, for standalone business, close to around 220-230 basis points. So that's, one data point to, kind of, keep at the back of our mind. There are multiple reasons specific to this quarter. While HI growth has been, lower, but hair colors growth has been extremely strong, and so has been the growth also for air fresheners. Now, both hair colors and air freshener are the categories which get maximum gross margins, in our portfolio, much higher than what household insecticide, gets, as well as much higher than what, soap kind of gets for us. So there is definitely a favorable category mix in this quarter. The other is we continue to still enjoy the benefits of low cost, palm oil, which has resulted in meaningful expansion in soaps gross margins and in turn the overall, kind of businesses gross margins. The third is the cost saving program, which we have been, running since last, 3-4 years, and that keeps on adding again in a very meaningful way to our, gross margin, expansion. So I think these are the 3-4 drivers, which has resulted in, close to 200 bips gross margin expansion, something which we also saw, I think, in some of the previous quarters. So I think it's more of continuation, of the same, bearing the impact of, category mix in this quarter.
And I think again also within HI, you've had some formats which have done better, and the formats that have done better for us are higher gross margin formats. So even in that, while HI performance as a whole was challenging, from a profitability perspective, I think, we did see some of the higher margin formats do better.
Understood. And thank you so much and all the best. And apologies for the noise, actually. I'm traveling and literally on the road. I'm sorry.
No issues. Thank you, Manoj.
Bye.
Thank you. We take the next question from the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity, sir. Couple of questions. How has Strength of Nature done after the acquisition? How's the revenue trajectory been post-acquisition, and whether it's delivering in line with what you were expecting from it? That's question number 1. And second is, if I look at the quarter, how has been the growth before and after the GST rate cut was announced in November? Did you see a strong volume growth because of the 6-10% lowering of prices in certain categories? That's it.
So, on Strength of Nature, the investment thesis, the US market is far more mature and penetrated. And so the investment thesis was to maintain steady growth in the US, but leverage the portfolio and bring the portfolio to our countries in Africa, where the headroom for growth is extremely significant in the category. So in terms of how the investment thesis is playing out, I think it's playing out the way we had expected. We have localized manufacturing of the Strength of Nature portfolio. A few brands have already been manufactured locally. A few more will be added over time. But the story will play out in terms of localizing manufacturing and using the portfolio to drive growth and provide a set of great products for our consumers based in Africa. Within, I think, the Strength of Nature portfolio, if I look at a 9-month basis, year to date, for our US consumers also, the growth is in line with our expectations. However, in Q3, the growth was below our expectations because, as I mentioned, we went through a fairly complex implementation of a new ERP system that resulted in sales slowing down in October and November. And while the sales picked up in December, we could not make up for the shortfall in October and November. But beyond this, temporary hiccup that we saw in the business, largely from an investment thesis perspective, things have been in line with the way that we wanted the Strength of Nature acquisition to play out. Samir, do you want to talk a little bit about the volume growth?
I think on your second question, Kunal, we have seen that, and now I would say for the second time, post GST and more importantly the rate cuts and also in turn the price, kind of reduction, we have seen pickup in volumes. We did see that for hair colors as well as air fresheners post mid-November, and we also had similar experience post June, kind of MRP drops, primarily driven by GST rate cuts.
Sure. So there is a fairly high degree of elasticity in that case. Like, it's not really a large cut, right? 6 to 10%, and you're seeing an improvement in the volume growth trajectory. Okay. Just one last question, if I can. Like, in general, are you getting more positive on the macro situation in the international markets with rising commodity prices and growth outlook? Are you more confident about the macro situation in your international operations?
I think it depends country by country. So clearly, if you look at some of the larger countries, the macro outlook in the US is very positive for next year. For Indonesia as well, the outlook is actually quite positive, and Indonesia is projected to be amongst the higher growth emerging geographies next year. The outlook for Kenya also is more positive. The outlook for Nigeria is also quite stable to positive. There are worries on South Africa in terms of how the reform agenda will play out. So South Africa has been macroeconomically an area of concern. But again, in some of these geographies, I think, there is plenty of opportunity for growth. But as I look at our entire portfolio across most of our geographies, the sense of the outlook is much more positive next year than it was the following year. Last year, sorry.
Great. That's very helpful. Thank you, sir.
Thank you.
We take the next question from the line of Nilay Shah from Morgan Stanley. Please go ahead.
Thank you. My first question is actually on Indonesia. Just focusing out there a little bit, have we lost market share in that market for HI?
Yes, Nilay, we have lost market share, but not at the same level at which we've reduced price discounts.
Okay. So then, could you help me understand this better in terms of the fact that there was a issue with increased competition out there, and that competition was either directly or indirectly to do with pricing. We've lost market share, and yet our margins have been rising pretty rapidly over the last few quarters. I understand the cost-saving programs, etc., which are underway, but why would the margins be expanding like this in a market where primarily there's a cost-led issue and you're losing market share?
So, Nilay, I think to begin with, the high competitive intensity was more driven by the consumer offers and not actually the price cuts. So that's one
That's
thing.
indirect pricing, right?
So this were altogether, kind of buy, aerosol can and get, 2 liters of, cooking oil, kind of free. Now, this in isolation doesn't in any which ways, affect, market share, right? I mean, so that's, the first part of it. To answer your second part, which is more of, despite this high competitive intensity and higher, kind of consumer offers or, kind of trade offers, in this case, why the margins are, kind of moving up. So there are two, three drivers to it. One is we have cross-pollinated cost saving program PI from India to Indonesia, which got cross-pollinated at the beginning of the year, flag end of last year, and that is, kind of repaying, rich dividends. Second, there is, kind of a skew from media investments to, kind of sales promotion or trade promotions, because the nature of market or more so the nature of category is such that right now everyone is, a little bit more skewed towards, trade offers and consumer offers, at least in HI as compared to media investments. That is also at overall level resulting in lower advertisement and sales stroke trade promotion spends on a YY, kind of basis. So I would say these are the two, primary reasons why despite not having the scale, kind of, leverage, we are seeing, kind of margin expansion in Indonesia at this stage.
No, I'll take it offline with you, Swami, because I still don't understand this trade-off. But yeah, I'll take it offline. But just extending this question to the to the India business, you obviously are seeing a massive elasticity, at least in the hair color business, with lower pricing. Would you and given that you are one of the market leaders, or you are the market leader, and you want to grow the category, obviously with the innovation, you think we've been too aggressive with pricing in the past? Then is this a lesson to that effect?
Hindsight is always 2020, right?
No, I think we've had the same competitors. So sometimes people want to play the market in a certain way, and we are making a certain amount of choices, correct? Discounting also is not a very sustainable long-term business model.
And I think the important thing is to look at 2-year CAGR, because if you compare things to, an abnormally low base, it does inflate the numbers. But as we look at it, on a 2-year CAGR basis, it was an 8% hair colors, which is again, in the past, hair colors has delivered low double digit, 12 to 13, 14%.
It's been extremely volatile. It's been extremely volatile, this category, and there have been different reasons for it. I totally appreciate that. But
yes.
Given this big spike that you're seeing at this point in time, and you are putting it down largely, amongst other factors, but largely down to a cut in the product pricing, and given your strategy that you really want to accelerate the category growth itself, it appears that we may have missed a trick in terms of at least the margins. But again, we can discuss this in detail offline. And the last question is just to understand why has there been this overall volatility in the hair business? What is the underlying growth driver for hair colors, apart from pricing that we've seen this quarter? What really drives the category growth? Because it's been all over the place. Some quarters negative, some quarters very strong.
I think if I separate the portfolio and look back over the last 3 or 4 years, what has consistently done very well for us has been the journey towards premiumization. And as we try to upgrade consumers from powder to cream, cream has been a very consistently strong story for us for almost 4 years, 4 years now. The volatility has been caused a little bit by the challenges of trying to retain some of our powder consumers. And so
the ones not upgrading to our cream.
Yeah, and so, so the powder segment is the one where we've seen volatility, and there again, I think we are now looking at various ways to drive some more innovation to be able to, drive growth in powders. But that's really been, I think, the strategic challenge which creates some choppiness in terms of the powder segment. Long term, again, I think, if we continue and persist on the creme story, this should continue playing out for a long time in terms of better growth. But I think for us, the challenge has been how to stem the erosion on the powder side.
And what's the application ratio that we have for powder versus creme? in terms of, number of applications? Because I really can't look at this in volume terms, nor can I look at this in value terms. So per
I don't
application.
understand your question.
I can't look at, the...
Yeah, you can use it as a per unit. Look at it as a per unit.
Yeah, per application.
Per application. Some people mostly use it once. Some people use even creme and powders twice.
So would we say that now it's 50-50 in terms of the number of applications of powder hair dye versus creme?
No. Powder volume is still high.
Let's take this offline. We don't have this data readily available, but I think if we just take this offline, we'll try and just take
And
this
we don't
information
give
for
the
you.
breakups of the volume.
Okay, thanks a lot.
Thank you.
Thank you. We take the next question from the line of Prasad Deshmukh from Bank of America. Please go ahead.
Two questions. Firstly, the growth narrative, Vivek, that you mentioned, distribution, penetration, new launches, and so on, that remains the same as it was in the last 3 years when raw material prices were coming off. Now that the prices are moving up, and assuming that the trend continues, will the new launches be still margin accretive at the gross margin level? And second, what gives you confidence that the PAT growth in that context will still be in sync with revenue growth?
From our perspective, Prasad, generally as a guiding rule, every new innovation that we launch ideally should be higher than the growth margin of the category. Unless it's for very strong defensive reasons, but from an innovation perspective, the team works on trying to make sure, and so over time that gives us enough confidence that we will start seeing the gross margin of the overall portfolio continuing to improve over time, largely led through innovations. At the same time, the team continues to do a very good job of trying to reduce costs, whether it's through manufacturing efficiencies, better sourcing, more scale advantages, to be able to also try and ensure that the core also gets better from a gross margin perspective, as well. So I think if I look at our gross margin performance, and you can see that over the last many years, I think consistently we've managed to improve gross margin. That's the direction that we continue to be able to push the business towards. Now, if you start looking at the other parts of the P&L, generally our marketing, advertising and promotion spend does tend to be somewhere between 10 to 12% of sales, and we believe that that's a good range for us to be in. There could be some changes quarter on quarter. There again, through things like market mix modeling and other tools, we can try and do more for the same amount of money. It's not about cutting spend, but how do we extract much more ROI from the kind of spends we are making. And then there's always opportunities for us to be more efficient, whether it's in our overheads, in our G&A, and that's par for the course. But ultimately, if we can continue driving gross margin, I think the team feels quite confident that we should be able to grow profits in line, if not ahead of sales growth.
Just to add to what Vivek shared, Prasad, I think at this stage we also have, relatively lower cost, covers for palm oil and also for other, raw materials as well as packaging materials which are linked to crude. We do have medium term, committed contracts from a lot of our vendors. So that is also something which will ensure at least for next, couple of quarters, gross margins will be, quite robust.
Okay. And second question, could you give a quick update on your rural one and also expansion in B-Blunt?
So I think rural one is, shaping up in line with our own, internal expectations. And if I had to kind of just give, smaller example, I mean, honestly, what we're doing in terms of the micro marketing initiatives in Godrej #1, as we talked about it, in soaps is actually in a way a fallout of some of our rural one kind of initiatives. So I think it's shaping up quite well. Though there were channel disruptions, whether it be demon or whether it be GST, but those were temporary pauses. But it's up there, whether it be the kind of investments more so kind of on ground. activations, more feet on, ground and so on and so forth. So that I think is, shaping up quite well, and hopefully will raise, much more richer dividends once we see a bit of macro recovery even on rural front over next, kind of few quarters.
And B blend?
B blend is also shaping up quite well. I mean, the Salon Secret is doing quite well, again in line with or maybe a little better than our, kind of internal expectations.
So is it now like present across India in the modern retail format at least, or is there some time for that?
So it is present more so in the premium general trade outlets because that's our go-to-market strategy for B blunt and that's
modern trade.
And modern trade.
Yeah.
So I mean, these are the two channels which we are tapping into for B blunt.
Yeah.
I think it's in terms of reach as well as in terms of business size ahead of our expectations, but the growth is, I mean, humongous. I mean, for B blunt in a way in terms of getting into much more number of outlets as well as beefing up its presence in modern retail.
Okay. Sorry?
And e-commerce also.
Okay. Just one last question, or rather clarification. The change in US dollar denominated debt, that is directly adjusted to the balance sheet, right? There is no pass through in the P&L.
Yeah, that's right.
Okay.
That's right.
Yeah. Thanks a lot.
Thank you.
Thank you. A reminder to the participants, to ask a question, please press star, then 1. We take the next question from the line of Amit Sachdev from HSBC. Please go ahead.
Hello. Hello, can you hear me?
Yes, Amit. It will help if you can be a little louder, please.
Sure, because it's on a headphone, I'm just trying to adjust it. Samir, is this okay now?
Yeah, this is much better. Thanks.
Okay. Samir, just had a small question on Indonesia. So, I see Vivek making a comment about changing in a bit of go-to-market strategy as well from predominantly modern trade driven to general trade driven. Can you give us a little bit more color on what is your current reach? And I think this has been touched upon a while back as well on Indonesia, whether you wanted to, I think, I don't recall, but I think that time coverage was 200,000 outlets and they are potentially 700, 800,000 outlets. So where we are on that journey now, and say what is the target for each 1 year or 2 years from now?
So Amit, I don't have the numbers in front of me on the outlets, but just let's take it offline and we can give this information to you.
Sure.
At an overall broad construct level, overall the market is 60% general trade, 40% modern trade, and our salience is the opposite.
Sure.
And so that's why I think, and now that we have hair colors in the portfolio and we have more affordable products, we do have the basket to be able to now push much more harder on the go-to-market model as well. But I think just let's take it offline and we can share with you the exact number of outlets we cover and how much that journey has moved.
Sure. That's very helpful. And Vivek, can you share some numbers around how the HI portfolio has actually done and non-HI has done, and what was the pricing versus volume in Indonesia? Some color on that.
Yeah, so I think HI portfolio continues to be the laggard. I mean, so when we read, 2% decline, I mean, HI has, kind of declined much, higher than the 2% overall decline. The non-HI portfolio has been in, positive zone.
Sure. So in terms of pricing, what sort of price discounting or at least what pricing pressure is sort of is reflecting on this growth? So why I'm asking this is that basically from HI point of view, just to defend the volume, how much discounting you have been doing and how it is tapering off? Just want to make a sense of it. That's the reason for asking this question.
Yeah. So again, directionally, I think, as we also, shared earlier, the competitive intensity is more of the same. Maybe as marginally, kind of diluted down over last, 2 quarters, 3 quarters. For us, though, the percentage of, kind of trade stroke, consumer offers or sales promotion spends has come down, but it's more driven by our efforts in terms of making the spends much more crisper, analytically driving a lot of these investments, tracking the ROIs and seeing that what is working really very well for us in terms of the eventual, offtake.
Sure. And A&P was also cut, right, this quarter, or rationalized. How the journey would look like in FY19? Are you willing to step up that spend, or would this be much more promotional led? And how these two trade-offs are happening?
I think it's going to be eventually a fine balance, but more so, we won't shy away from investments if we see recovery in macro, which we think gradually would be the case to begin with, as well as some of our new product launches will, need some, upfront marketing investment. So I think we will see, kind of uptick in advertisement spend. And hopefully by then we will see perhaps also, gradual withdrawal of this, high competitive intensity and hence toward, sales promotion.
And we do believe that there are opportunities to be able to reduce some of our overhead costs there. And that money will get redirected towards higher advertising spend. So clearly, I think, as we launch the innovations, we do want to invest more in advertising and A&P. But the team is quite confident that through operational efficiencies and cost reduction projects, we will find the money to be able to deliver acceptable profit growth, but invest in our brands as well next year.
Sure. No, that's very helpful. Vivek, just to get some sense of when you look at Indonesia next year, would you say that given that discounting will sort of wane off and some new product launches will happen, are you sort of looking at a year where revenue growth could, given the outlook of macro is also at least better and you will go to more general trade as well? Is it like, can you envision a year where you have like a high single digit revenue growth, that's a target, or you're looking at double digit sort of view, or it would be very gradual, mid single and low single, and then eventually build up? How the trajectory you are envisioning?
I'm somewhere in the middle. No, I think clearly, I think the intent is going to be to get to double digit growth, but a lot will depend again on how well the innovations play out and the macro environment. Indonesia has provincial elections next year, presidential elections the year after. Typically, the economies do quite well during election years because there will be pressure, I think, on minimum wage increases or to increase consumer spend. So a lot of those factors honestly should help the business, but I think we'll have to at this stage just ensure even a transition to general trade or trying to push on GT doesn't happen overnight, right? It takes time. So sure. I think all the building blocks are being put into place, but a little, frankly, a lot will depend on the consumer spend environment and how well innovations play out. But the team is definitely quite optimistic that next year should be much better than what this year was.
Okay, all right, Vivek. Thank you so much for taking my question. All the best.
Thank you.
Yeah.
Thank you. We take the next question from the line of Harit Kapoor from IDFC Securities. Please go ahead.
Yeah, hi. I just had two questions. Firstly, just wanted to understand on the personal repellent space, what proportion of the overall HI piece would it now be? And on that also, what's the kind of growth trajectory there vis-a-vis the at-home HI space? That's my first question.
So, as you know that the in-home HI space is about 5,000 crores. The out-of-home space would be about 150 crores. Obviously, the out-of-home space is now growing much, much faster than the in-home space, given the sort of size. What we have seen with our fabric roll-on is extremely encouraging. So, if you give consumers a product which is sort of very easy to use, it's natural, they just apply it on their clothes and they can go, we are ahead of our plan. So we are sort of really excited. And if you look at other countries also, if you look at the US, Indonesia, as a percentage of the in-home markets, the out-of-home markets are much, much bigger. I think what's happened in India is they've not been the right set of products for Indian consumers. There's been very, very little investment in habit creation. And I think now you see that growing. So we see this as an extremely strong vector for us.
Okay. Thanks for that. Second question was on the working capital part. In your presentation, there seems to be a reduction in terms of days, which is reasonably sharp from September to December. Just wanted to understand whether this is more it's more seasonal in nature, or there's something sustainable in this that you've done, and if you have, then in which market is this reflecting?
I think it's quite broad-based, largely originating from India and Africa. I think there are a few drivers. One is lower inventory levels when you baseline this with September end. There has been also higher payables, more so driven from our African business. And in India, we have also got close to around 40 crores of excise refund from tax authorities, which also helps in improving working capital. To answer your question, I think this happens to be one of our key pivot to the overall ROC improvement alongside driving profitable growth. So we will continue to see meaningful improvement in working capital levels from here on.
Okay, that's it from me. Thanks.
Thank you, Harith.
Thank you. We take the next question from the line of Naveen Kulkarni from Phillip Capital. Please go ahead.
Congratulations on a good set of numbers, and thanks for taking my question. I have a couple of questions on the margins. So if we look at the domestic margins, this quarter the margins were 28%, so that I would believe that are reasonably high level of margins. So one is the sustainability going ahead, and the second part is, are these margins very close to the management's aspirational levels? That's one. Second is, how do you see this opportunity in terms of the high level of profitability that we are seeing? Is this an opportunity to launch more new products or do more inorganic acquisitions in India? So how are you viewing this strategically on a long-term basis? What is the opportunity here? And third aspect is on the international business. While there are a couple of countries which were not doing so well in terms of margins, but overall the margins are fairly reasonable. So how do you see that panning out going ahead, especially for countries like Indonesia, where the margins are at 25% are reasonably at high levels?
See, from a margin perspective, we focus on consolidated margins, and the effort is to drive consolidated margins ahead of sales growth or in line with sales growth. And so we do not actually try and optimize margins at the individual geography level, because competitive dynamics, innovation, strategic reasons dictate what the margin profile of this business is at that level would be. And then again, the choice of inorganic actions is not determined by margins. At the end of the day, what drives acquisitions is fit with strategy, how attractive the asset is, and are we the rightful owner for the asset, and can we buy it in a value accretive manner? Are we actually being accretive in terms of the right valuation? Those are the right reasons. So I think, while the margins in India have been very good, the margins in Africa have not been very good in this quarter. So as we play the portfolio, there could be some quarters where India margins might fall down because of new launches. But then we will try and make sure at an aggregate level, our profit growth is in line, if not ahead of sales growth.
But I think one on this margin and new products and investment in it, I think one thing we've been really focused on in product design, whether now in India or Africa, and we're building this up even more, is making sure that we get to NC positive even in year one on some of our products, correct? So the way the product design, so it really means that you look at cost pricing very carefully, but you also make sure that you're very innovative and sort of disruptive. So you're not going in with me too, because your advertising money just goes much, much further if you stand out in the market. So that's become we've seen it in our successes, whether it's Expert Creme, Air Pocket, fabric roll-on, the kind of results we get with that. So I think one thing you will definitely see with GCPL is a really strong focus on that.
Yeah. I think the other important thing from a philosophy perspective is that we don't manage the business for margin. That's an outcome. I think we look at the underlying drivers in terms of, gross margin, marketing spend. Are we gaining share? Are we creating the right exciting products? I think if you do that, margins will be an outcome more than anything else. But we're very careful not to try and over-manage the business from a margin perspective. And to some degree, absolute profit growth is probably a more important indicator than necessarily quarter-over-quarter margins.
Okay, so what I was trying to ask also is that absolute profit growth will be reasonably high if the margins are at these levels. So how do we see the sales growth based on the kind of margins that we are at this juncture? So is there more opportunity to drive sales growth at a much higher pace from here? Are you seeing that as a big opportunity now?
See, at the end of the day, the biggest way to drive margin is to do better sales growth, because the operating leverage you get from higher sales growth really is the best way to be able to ensure acceptable profit growth. I think our intent and aspiration is to drive sales growth much higher than where we are today in the categories that we are in and the adjacencies that we are pursuing. If you look at both penetration rates and consumption rates across the board, whether it's India, Indonesia, or Africa, there's tremendous headroom for growth. Having said that, though, we do get constrained by the overall economic environment. And so if the economic environment improves, that actually means higher disposable income in the hand of consumers, which allows them to spend money on branded, affordable products that we provide. And so we keep on trying to get innovation. So a lot of our growth will from innovation. Ultimately, I think the aspiration is to drive sales growth much higher, but it will be a function of the overall economic and consumer spend growth as well.
Okay, thanks a lot.
Thank you.
Thank you. We take the next question from the line of Binoy Jariwala from Sunidhi Securities and Finance. Please go ahead.
Hi, thank you for the opportunity. Could you share some thoughts on where are we in terms of cross-pollinating various products? Because when I look at certain geographies, for instance, Indonesia or Africa or Europe, we are just about present in one or two of our three broad categories. So could I have your thoughts on these, please?
See, companies look at cross-pollination in different ways. One form of cross-pollination is taking products and brands from one country to the other country. While we do that on a selective basis, behind the scenes, a lot of our cross-pollination tends to happen from a technology sharing perspective. And so whether it's, air freshener development in Indonesia and India, it may not be visible to the external community.
But we've had, like in Indonesia, the latest two launches have been Stella Pocket.
Yes.
This is non-HI, Stella Pocket, which is basically air pocket, and new hair color cream, which is similar, very much similar to it's between Expert and Be Blunt somewhat. So what we do have is we do have a global product sort of portfolio. What we don't have is that we don't bring them under the same brand, but there is a lot of product sharing that's going on. A very interesting thing that you will see within a year or 6 quarters is some of our learning on African hair and straightening products there and things like that, which we will bring to other markets, because the learning actually is pretty big, and curly hair doesn't just exist in Africa. So you will see a lot of our learnings, but you won't see them in the same brand.
Sure, that I understand, but is it practical and is it possible to build each of these geographies with a presence across all the three categories, maybe over a time frame of 5 years or 7 years?
But I didn't understand your question. I mean, we're doing HI and air fresheners in India and in Indonesia. the product portfolios are very similar in both the markets. We are doing HI in Africa. Plans are to ramp that up quite significantly. I didn't understand your question.
So I think the question is on soaps. I don't think we intend to necessarily get into the soap category in Indonesia or Africa. I mean, we have a small soap factory. So soaps more opportunistic, but hair colors, air fresheners, insecticides, I think are categories that, we do believe we have a clear right to win across multiple geographies.
That's very helpful. Second is, what would be our the sales mix between urban India and rural India?
So around 26-27% of our salience would be from rural, and the rest would be urban in our general trade, channel sales in India.
Sorry, I didn't get it.
Around 26-27% of the salience would be from rural, and the rest would be, from urban in our general trade, business in India.
Sure, understand. And in terms of gross margin across the categories, if you could just help me understand the pecking order, which categories have the highest gross margins, which have the...
So in terms of sequence, I think it's hair colors, followed by air fresheners, followed by household insecticides, and then soaps.
Okay. And our cost savings program that we run on an annual basis, what would be the quantum for FY18 and 19 that we are targeting?
So for FY18, I think in India, the cost saving programs have been contributing close to around 1% to 1.5% on revenues, and I think that trajectory and momentum should continue for us even in FY19.
And the international geographies?
The international geography, this is just kicked off. I mean, in Indonesia, we just cross-pollinated Project Pi. So I think it's in very early, stage at this, point in time. So I think it should scale up. But again, I think we should see similar benefits as what we have seen in India, even in Indonesia and perhaps few other, markets.
Okay. Thank you so much. That's from my side.